It's July 2025, and the U.S. economy looks unstoppable on the surface. The S&P 500, widely seen as the clearest barometer of American corporate strength, is pushing toward the monumental 7,000 mark. Unemployment hovers at just 4.1%, while inflation sits at a relatively tame 2.7%. These are the sort of numbers economists dream about. By virtually every traditional measure, America is experiencing one of the most impressive booms in its history. The last major economic collapse happened nearly 2 decades ago during the 2007 to 2008 financial crisis. Since then, the country has not seen a true, drawn-out recession. That means an entire generation of workers and investors has grown up without any direct memory of what a crash feels like. To them, the idea of markets tumbling, jobs vanishing, and assets evaporating overnight is almost alien. Even among financial experts, the very notion of a downturn feels increasingly abstract. This generational gap in experience has shaped a unique psychology. Today, every dip in the market is seen as an opportunity, something to be scooped up, not feared. The rallying cry is that stocks only go up. And not just stocks, housing, cryptocurrencies, and nearly every other asset class have seemingly defied gravity. For those who embrace this mindset, the payoff has been extraordinary. Fortunes have been made by simply believing the bull market was indestructible. But what if this seemingly endless prosperity is actually built on the flimsiest of foundations? What if, beneath the surface, this is the biggest bubble the world has ever seen, one that could unleash catastrophic consequences when it finally bursts? Right now, the optimism is so intoxicating that imagining a serious downturn feels nearly impossible. Yet when you step back and look at the hard data, cracks in the facade become alarmingly clear, warning signs in the numbers. Let's begin with a simple, well-known measure, the Buffett indicator. This metric, popularized by Warren Buffett, often considered the greatest investor of all time, compares the total value of all U.S. publicly traded stocks to the size of the U.S. economy as measured by GDP. The logic is straightforward. If the stock market's total value balloons far beyond the real economy that supports it, valuations are likely detached from reality. Buffett himself once remarked, back in 2001, that this was probably the best single measure of where valuations stand at any given moment. He issued a stark warning. If the ratio approached 200%, as it had during the dot-com bubble of the late 1990s, investors were playing with fire. Fast forward to today, the ratio has smashed through that red line, standing at a jaw-dropping 209%. In other words, the market is worth more than double the economy it supposedly reflects. That's not just high, it's the most extreme level in recorded history. Another critical measure, the Shiller CAPE ratio, cyclically adjusted price to earnings, paints a similar picture. Unlike the traditional price to earnings PE ratio, which can be distorted by short-term spikes or dips in profits, the CAPE smooths things out by using 10 years of inflation-adjusted earnings. This makes it especially useful for spotting bubbles. Back in 1999, right before the dot-com bubble imploded, the CAPE hit a peak of 44. That was considered extraordinary at the time, and indeed the market collapsed soon after. Today, while not quite as high as that extreme, the ratio still sits at dangerously inflated levels, suggesting that stock prices are far out of step with the earnings underpinning them. Lessons from history, the pain of market collapses. To understand just how destructive a bubble's bursting can be, it's worth revisiting the crashes of the past. Take the dot-com era, for example. The S&P 500 plummeted nearly 50% from its peak, and it took more than 7 years to claw back those losses. The Nasdaq, which was more heavily weighted toward speculative tech companies, fared even worse. It collapsed by an almost unimaginable 79%. Investors who had piled in during the mania waited until 2015, a full 15 years later, just to get back to even. These kinds of losses are not just paper numbers. They ruin retirements, crush dreams, and wipe out years of careful saving. Yet today, many younger investors dismiss warnings of a downturn as outdated paranoia. The prevailing mindset is smug confidence. Have fun staying poor is a popular retort to skeptics. But this kind of arrogance is precisely what makes bubbles so dangerous. It blinds people to reality until it's far too late. Buffett's perspective: human behavior never changes. To get a sense of how irrational markets can become, we can turn again to Warren Buffett. In one off-cited clip, Buffett reflects on investor psychology. He explains how people tend to extrapolate recent history. If they've been making money, they assume the trend will continue and often borrow even more to invest. If their neighbor has profited, they jump in too, afraid of missing out. Conversely, when returns dry up, they flee, regardless of whether the underlying businesses are actually healthy. Buffett emphasizes that this herd-like behavior creates enormous swings, both up and down. He recounts how the Dow Jones Industrial Average essentially went nowhere between 1965 and 1982, a 17-year stretch where investors saw no gains. Such stagnation crushed sentiment, even though living standards and the broader economy were still improving. On the flip side, he also lived through bubbles like the late 1990s, when worthless internet startups were valued at billions. As he often notes, anything that can't go on forever will end. The question is not if, but when. Perhaps most telling is Buffett's own behavior today. His company, Berkshire Hathaway, is sitting on an unprecedented $347 billion in cash. Rather than buying into this frothy market, he is waiting patiently, prepared for opportunities that will inevitably appear when prices come back down to earth. The world's most successful investor is refusing to chase the rally, and that in itself should give us pause. Flat markets, the silent killer of wealth. It's easy to focus only on spectacular crashes, but equally dangerous are the long stretches of stagnation that follow them. Imagine buying the Dow Jones Index in March of 1964 and holding until mid-1982. 18 years later, you'd be sitting on virtually no gains at all. That's nearly 2 decades of watching your investments go nowhere. For most people, such a scenario is unthinkable, but history proves it can happen. Similarly, the roaring 1990s ended in disaster. From September 1990 to December 1999, the Dow skyrocketed by an astonishing 368%, delivering average annual returns of 16%. Investors came to believe stocks were a sure thing, but the crash that followed erased much of those gains, leaving the index essentially flat until 2011. That's 11 long years of frustration and disappointment. Today's bull market has lasted even longer, spanning 18 years with barely a hiccup. It has shrugged off wars, inflationary pressures, banking crises, even a global pandemic that shut down entire economies. Each time, investors doubled down, convinced that the rally was invincible. But as history shows, no boom lasts forever. Why this time is no different. The current run is remarkable not just for its size, but for its persistence. Yet the longer and higher markets climb, the more painful the eventual reversion is likely to be. Valuations always return to their long-term averages, whether through sharp crashes or extended flat periods. That's the iron law of markets. When today's bubble finally bursts, the consequences will not be limited to stock portfolios. The ripple effects will spread everywhere. Housing prices, cryptocurrencies, and even job markets will feel the shock. The wealth effect that has fueled consumer spending will reverse, hitting businesses and employment in turn. Final thoughts. Right now, optimism reigns supreme. To most people, the idea of a major downturn feels absurd. After all, why should tomorrow be any different when the past 18 years have been one long winning streak? But that very confidence is the hallmark of bubbles throughout history. Investors dismiss warnings until it's too late. Buffett's wisdom is worth keeping in mind. Markets are driven not by logic, but by human behavior, by fear and greed. Today, greed dominates. But as soon as the tide turns, fear will take its place, and the shift will be brutal. We may not know the exact timing, but the data is unambiguous. The Buffett indicator, the Shiller-Cape ratio, and the sheer length of this bull run all suggest we are living in one of the most overvalued markets in history. When reality catches up, the fallout could mark the end of an era and the beginning of a painful lesson for an entire generation that has never seen just how devastating a crash can be. That was all from us today for this video, folks. For more similar content, make sure to subscribe to the channel. See you in the next one.